Today we are joined by Surge. Surge trades under the ticker symbol SGY and on the OTC at ZPTAF. Welcome, Derek and Ashley.
Thanks, Jessica.
Congratulations on an exciting quarter for you guys, by the way.
Yeah, so thanks, Jessica. So I'm Derek Christie, Senior Vice President, Geosciences here at Surge, and with me is Ashley Hardcastle, the Manager of Corporate Finance. Just jumping into the Surge story, I'd like to highlight a few key components of the company. So firstly, we focus on high operating netback, conventional resources with large original oil in place with low current recovery factors. We then use a disciplined capital allocation strategy to develop our low-risk drilling inventories in really our core areas of the Sparky and Southeast Saskatchewan. Led by Paul Colburn, we have a proven, experienced management team with a strong track record of execution. And really what this results in is the generation of significant free cash flow and really provides visibility to shareholder returns. Looking at Surge's net asset value, so utilizing our most recent Sproul report dated December 31st, 2021, and then utilizing that Sproul price deck, which is really equates to about a $70 WTI flat deck, we end up with on a total proved basis, $9.81 per share. And then when I think of that on a P plus P basis, that's $16.94 a share for Surge. Looking at the right-hand side of the chart here, we've run some sensitivities, and you can see that highlighted in green is that $80 deck. So, just $10 higher than the Sproul deck and significantly lower than where we are trading today. You can see that's $15.55 a share on a total proved basis. And then that jumps to $24.34 a share on a P plus P basis.
So in addition to the net asset value that Surge offers shareholders, Surge has also been independently recognized as having one of the top free cash flow yields in the Canadian energy space. So the two charts on the right here are done by independent investment firms, the top being done by Peters & Co. out of Calgary. And it shows that on a debt-adjusted basis for 2022, Surge will have a free cash flow yield of 42% compared to the peer average of 33%. And then down below, the chart was done by 9 Point Energy Partners and shows in 2023, Surge will lead the group again at just under 40% free cash flow yield compared to an average of 23%. And in addition, Surge has accumulated approximately $1.3 billion in tax pools that will shelter the free cash flow that we're generating and provides an attractive multi-year tax horizon. So this slide sets up the macro backdrop for the run-up in crude pricing that we're seeing. So there's been a chronic underinvestment in the oil and gas industry over the last several years, which is now resulting in significant draws on crude inventories throughout the world and in the US. Which has many analysts calling for crude to reach well over $120 US as economies reopen and demand picks up. This slide highlights how energy is a great natural hedge against inflation for investors. So very topical today with the inflation that we're seeing. US inflation is now posted over 8% and Canadian inflation is just under 7%. And oil and gas stocks have a track record of outperforming the market during these inflationary periods, as you can see in the chart here. Surge's 2022 corporate guidance is focused on shareholder returns and enhancing free cash flow. So we are forecasting production of 21,500 BOE per day for the year on a sustainable capital budget of $124 million. So at $85 WTI, this will generate 2022 cash flow from operations of $295 million and 2022 free cash flow of $170 million on an all-in payout ratio of 42% and an exit debt to cash flow ratio of 0.55 times. Last week, we were very excited to press release that we're accelerating our return to our shareholder returns business model. So on July 15th, Surge is anticipating reinstating our base annual cash dividend of 42 cents per share, which equates to $35 million per annum. And we did reconfirm the extension of our $150 million first lien credit facility, which was drawn less than $100 million at March 31st, and that we are in receipt of an incremental $30 million of term debt financing, which we plan to use to retire our convertible debentures that are coming due at the end of 2022, which all lends itself to a simplified debt capital structure for the company, significant liquidity, and no debt maturities through mid-2024.
That's great. Thanks, Ashley. So the next few slides, I'm just going to walk through some of the details of our asset base and really help to differentiate kind of our location inventory and just highlight some of those things with that. Surge is really focused on the conventional side of the reservoir spectrum. So when you think of truly unconventionals being the Duvernay, the Permian, the Montney, and then you think of conventional reservoirs being the Sparky and Southeast Saskatchewan, we're really focused in that conventional side. So really what that means is that we have greater permeability on the conventional side of the spectrum, which is really higher reservoir quality. What that gives us is really lower capital risk and lower decline profiles, ultimately resulting in greater IRRs and PIRs. So just greater economics, internal rate of return and profit investment ratios. And then on top of that, because we do have these conventional reservoirs, it really offers the low risk, predictable, repeatable development and the opportunity to improve recovery factors through really, when you think of that, through water flood, which helps to really mitigate decline rates and just adds low cost barrels. On this slide, it really summarizes the company in a nutshell. When you see fundamental to what we have is 2.6 billion barrels of oil in place over our resource base. Thinking to, based on recovery factors, that's 6.5% cum to date from that. And then when you think back to the independent reserve report that we discussed earlier, that's 9.6% on a booked recovery factor basis. Looking at analogous pools to this, we see primary production recovery factors of up to 20%. And then when you think of water flood, up to 30%. So when you think of that in context, just a 1% change in recovery factor based on this is 26 million barrels of recoverable oil. Then looking at the total booked drilling locations, so that's 456 booked drilling locations associated with that reserve report, but then our total inventory is over 950. So again, a great runway to see that improved recovery factor. The next few slides will go through just the details of our top plays, being the Sparky and Southeast Saskatchewan. Importantly, 2/3 of our production come from these two core areas, and then 85% of our capital spend in 2022 is in these two core areas. Obvious question is why? Why are we spending all of our money in these two core areas? Well, if you look on the right-hand side here, this is some independent research that was done by Raymond James, ranking all of the top oil plays in Canada. The criteria for ranking was when a well reaches its second payout. So you drill a well, you get your money back. When do you get your money back again? Then they ranked all those plays. The top plays that kind of rose to the top were our Sparky in Alberta, Southeast Saskatchewan conventional, the Clearwater, and the Charlie Lake. When you look at our two core areas, being the Sparky and Southeast Saskatchewan, that makes up 2/3 of our drilling inventory. So we're exposed to these two of the top four plays, but importantly, 2/3 of our inventory lie within these plays. A little bit of detail on the Sparky. The Sparky is part of an 11 billion barrel oil trend, one of Canada's largest accumulations. We're really focused in the light to medium gravity window, which is greater than 20 API. So of that, there's 4 billion barrels in that light to medium gravity window. And importantly, we see 20,000 vertical wells that have been drilled in this part of the Alberta. So it gives us a lot of geological data. We incorporate that with 3D seismic over all of our existing pools. And then we utilize all of the engineering modeling that we have to just end up with a really integrated reservoir model that helps to de-risk our past drilling. So we've drilled 200 successful wells, multi-stage frac wells. And then going forward, it helps to really de-risk our go-forward runway of 400 drilling locations in the Sparky. As I highlighted before, you can see where the Sparky ranks. It's in the top 4 of the 2 times well payout. And then one of the real key factors here is that we have low cost to drilling. So that's 1.3 million on a drill complete equipment tie-in per well. Deep inventory of 12 years, great economic netbacks. And then we see that 800 million barrels of oil in place net to Surge here, more than 400 drilling locations. And then we have really grown this from essentially zero through some strategic acquisitions and core drilling. We can see we've grown that to 9,000 barrels a day. Something that's reasonably new for Surge this year is our re-entry back into Southeast Saskatchewan. So through some really strategic acquisitions last year of Astra and FireSky, we re-entered this area. It's an area that certainly Surge is familiar with, having worked here in the past. Myself and Paul Colburn have had numerous companies that we've worked with down here. So we saw this as a real great opportunity for Surge. We like it for a number of different reasons. One of the main ones is just the great capital efficiencies we see down here. Very low cost of drilling. These are $900,000 per well. And really what the low cost is that we do not need to frack these wells. We're drilling conventional horizontal wells and then just producing them. So it really gives for some great quick turnaround. Out here, we see lots of good organic opportunities. And I think that's really highlighted by some of the recent land sale activity where we're able to do some organic mapping and come up with some great opportunities that we've developed down here. Again, why do we like Southeast Saskatchewan? So it really ranks in the top of any oil play. We see $60 netbacks at $85 WTI. We have more than 250 drilling locations. So again, we have an 8 to 10 year drilling inventory out here. Through the two acquisitions of Aster and Firesky, great asset base of 5,000 barrels a day and really great capital efficiencies. So between the two plays in the Sparky and Southeast Saskatchewan, it really gives us a great framework to be able to develop our inventory here.
So moving to ESG, Surge has a very strong commitment to ESG and being a sustainable operator, which is highlighted by our actions. So we did publish our inaugural ESG report in December of 2021. And I encourage anyone that's interested in reading the report to go onto our website and take a look. And then we also completed several important ESG projects in 2021. So we did abandon greater than 260 wells in the year, which represents abandoning 5 wells for every well that we drilled in the year. And then we completed 2 significant gas conservation projects, a 45-kilometer gas gathering system in Southeast Saskatchewan, which allowed us to reduce our Scope 1 emissions by 45% in the area, and then a gas conservation project in Southwest Saskatchewan, which allowed us to conserve 70% of our Scope 1 emissions in the area.
Just to finish off, you can see that we have a fairly deep analyst coverage here. That helps to really just solidify our story, and we're really excited about where we're going. We've developed a great asset base, and we definitely have the inventory to continue on, and really excited about where Surge is going in the next year.
That sounds great, guys. It definitely had a lot going on in the quarter. Let's touch on your Steelman discovery a little bit, if you don't mind. As you said, you had great success at a land sale just recently. Are there other small producers or land that you can pick up in the area?
Certainly, that's one of the things that attracted us to Southeast Saskatchewan were the organic opportunities that we see. We're always looking for small opportunities that can help to upgrade our inventory. But as I showed in the previous slides, we really don't need to do anything, but we're always looking for accretive acquisitions that can help us to solidify and upgrade our inventory.
Okay. Now, 2 of the wells you've drilled in that area have been 2 of the top in the country, which a lot of people are starting to take notice of. Out of your 40 locations at Steelman, how many of those do you think are Tier 1?
Sure, that's a great question. 25 to 26 of those would rank in the top Tier 1 locations that we have in the company. Yeah, so again, about 2/3 of those would be Tier 1 locations for us.
Okay, so that's pretty exciting. Does this change now Sparky's very economic, obviously, as well right now, but Steelman's a little bit more economic. Will this change your capital allocation at all as far as your CapEx goes?
It really won't. But, the addition of these Tier 1 locations, really, it won't change our capital allocation between the Sparky and Southeast Saskatchewan. We do really like what's going on in both of those areas. But I will say that the capital allocation within Southeast Saskatchewan is going to change slightly. So we're going to be drilling a few more wells in Steelman. And in fact, we'll be drilling up to 6, maybe even 8 wells on the newly acquired lands in the back half of the year. So really doesn't change our approach overall, but it will just, in the specific area of Southeast Saskatchewan, we'll change it slightly. Okay.
Now, also, you implemented a dividend, but it still leaves you with a lot of free cash flow, as we saw in your presentation. Now, how do you expect to allocate that for the rest of the year? You're going to focus on some more debt repayment, but do you think you'll increase dividend, do a special dividend, or would you focus on buybacks? And would you increase your CapEx?
Yeah, good question, Jessica. So certainly our number one goal right now is further first lien debt repayment. So we had about $100 million drawn on our first lien facility at March 31st, and we'll look to have almost nothing drawn on the facility by the end of the year. And then from there, subject to board approval, we will also look to pull other levers such as implementing share buybacks, strategic M&A in our core areas, as well as potentially adding in a growth wedge to our capital program.
So that would be your ideal amount of leverage you would like to have in the company, sort of 0.5 times debt to cash flow. That the most efficient use of capital?
Yeah, we feel that's a good leverage ratio. And then we are looking to largely repair first lien facility. And then we will continue on with the 5-year term debt facility that we have currently drawn.
Okay. Now, on your ESG side, maybe we can touch a little bit more on, because you've done a lot of work on ESG. And if you want to explain in a little more detail, if we could go back to that slide maybe and touch on the gas gathering and the how that helps your GHG emissions, et cetera.
So yeah, for the Southeast Saskatchewan, that was a gas tie-in project. It's 45 kilometers of gas gathering pipeline that we've installed. And it is going to reduce our Scope 1 emissions in Southeast Saskatchewan by 45%. And then we have another project that we've done in Southwest Saskatchewan, which is a gas conservation project. And then that's designed to reduce our Scope 1 emissions in the area by 70%.
Okay, so can you explain a little bit more to me about how the gas conservation project works?
So we built that gas pipeline, and then we're able to conserve the gas from all the independent batteries at a central facility. So that's really, so we're able to reduce our flaring by tying that into the common facility through the major pipeline.
Okay.
Yeah, and an added benefit right now with gas prices being so high that we're able to conserve that gas and send it to sales.
Oh, certainly. Yeah, that is helpful to be able to capture that as opposed to flaring. Now, do you have other projects like this planned, or do you need any more projects like this? Do you think you've done the heavy lifting and now just focus on abandonment?
No, we are going to have a continued ESG budget every year. So we are putting together an inventory of GHG reduction projects that we can work through. So we'll implement more for reducing our emissions, and then we'll also continue with our strong abandonment programs. So we are anticipating spending $10 million in 2022 on abandonment work as well.
Thank you. And what would be your total abandonment liability on your balance sheet?
Yeah, so it's just about $300 million right now for our ARO organization. Yeah.
Yeah, $300 million, which is obviously amortized over what period?
Yeah, and that's on an undiscounted basis.
Okay, thanks.
Maybe I can just touch a little bit on inflation, because that seems to be a fairly topical discussion these days.
Yes.
I can talk about kind of what we saw in Q1. So going from 2021 into this year, we budgeted about a 12 to 15% inflation. So we're really happy that we were able to stay on budget with that going into Q1. We are seeing a little bit of cost pressures for the back half of the year, so monitoring that very closely, but then doing everything we can to really secure our services. So we'll be starting drilling here June 1st with 2 drilling rigs in the Sparky and then 1 in Southeast Saskatchewan. So really happy to have that equipment tied up. Seeing quite a bit of pressure on steel prices. So we're doing everything we can to pre-purchase a lot of our casing. So really, I'd say about 50% of our capital program we have locked up those costs, and happy to say that we have locked up the services to do that.
So you've locked up your entire service, all your services till year end?
Well, what we can. So we would have locked up the drilling rigs and then, made commitments to the additional services that we have. As I mentioned, that we don't have to frack our wells in Southeast Saskatchewan. And then we're also doing smaller fracks in the Sparky. So we don't have the high intensity fracks, but we have lined up those services as well.
Okay. We did touch on Steelman. Do you want to talk about anything on your Sparky program that you've just completed?
Yeah, sure. So we completed 18 wells in Q1. Of that, we've got about from the total program, it's about 2,000 barrels a day BOEs a day that we've got from that program. So results as expected or better than expected. When we move into Southeast Saskatchewan, we drilled 8 wells in the quarter. Total BOEs from those is about 1,400 barrels a day current production. And then we've recently completed a well up in Valhalla. We drilled a Doig well, a 50% Doig well. Just starting to see those initial production rates, but really excited about that as well. So overall, we finished up our program and now just kind of gearing up for the second half, which again, will be starting in June 1st here.
And those Valhalla wells, if I recall, can be quite significant. Yeah,
for sure. So some of the wells in the past would be 1,000 or 1,500 BOEs a day. We're hoping for something around that 1,000 BOE a day mark would be a success for us out there.
Okay. And so looking at this, and then you start obviously a lot of this is flush, and you're still forecasting 21.5, but it looks like you could, without adding any CapEx, potentially have an increase to your production.
I would say that our production is on track right now. So that's, as we've forecasted out the wells that we have drilled, this is what we have been expecting for our forecast. So at this point, I would not say that we'd be bumping our production forecast.
Okay.
But on capital.
Okay. And when can we expect an ops update in your Q2 report? Or do you think something prior to that?
Probably not prior to that, but we'll do like we usually do, a fairly fulsome ops update when we do our next quarterly release.
Okay. And we did talk about A&D, and you do have a lot of locations, but are you seeing anything that's interesting in, let's say, Alberta as well?
There is quite a bit in the market, but I think as we've shown with our asset base, we will be very disciplined because we have a great asset base as it sits. We do not need to go out and do anything that would be non-core, that's for sure. And anything we do would have to really make us a better company. So we're looking for, strong accretion across the board. We do see some opportunities for some core area top-ups, and we're continuing to work those. So also when we think of the organic opportunities, just like we did in Steelman, we're continuing to work up that organic opportunity list. We have done some things in the Sparky as well, maybe not quite as big as what we saw in Steelman, but always continuing to add to our core area through our organic opportunities.
Okay. So you think you maybe have some organic discoveries in the Sparky area that could expand?
Yeah, I don't know if I would call it a discovery, but we're continuing to push the edges of the play and
push the edges. Yeah. Okay, that sounds great. Are you willing to give an exit production rate for this year at this point?
Yeah, I would say not at this time. I think you can just say that we're on track for our 21.5 average.
You see, I'm really pushing you to try and get you to say higher. I don't think I have any other questions at this moment. Is there anything else you guys want to touch on?
No, I think that we hit the major parts of it. Again, really excited about the program we just finished off, then really looking forward to the balance of the year. I think one thing that really differentiates Surge from others is just the quality of our asset base. And we're starting to see that, and you can see from our results and then just our depth of inventory across all of our plays. So I think that's a real differentiation for Surge.
Well, historically, you were really one of the only companies drilling in the lighter portion of the Sparky, right? So, you weren't getting as much attention as potentially some other companies who were, when you have 4 companies drilling in the Clearwater. So, I think now people are really taking notice of the economics and, the size of the Sparky.